Almost every trader has a plan, and almost every trader violates their plan regularly. And the gap between those two facts is where most trading edge disappears, because having a plan and following a plan are not the same activity. They require completely different things from a trader. Having a plan is a cognitive activity that happens in a calm, clear-headed state. You define your criteria, set your risk parameters, identify your levels, and write it all down. And in that state, the plan feels obvious and right, because you're thinking clearly without the emotional charge of real money moving in real time. Following a plan is an execution activity that happens in a heightened state. The market is moving, the position is live, and every price change creates a small emotional signal that your brain processes as information even when it isn't. And in that state, the plan that felt obvious an hour ago starts to feel like it was written by someone who didn't understand what you're looking at right now. That feeling, the sense that the current moment is different from what the plan anticipated, is the most common trigger for plan deviation. And it's almost always wrong, because the plan was built to account for the full range of how setups look, not just the clean versions that are easy to execute. The distinction between having a plan and following one becomes sharpest at three specific moments: the moment before entry, the moment during the trade, and the moment at exit. And most traders who believe they follow their plan are actually following it only in the spaces between these moments, which is to say, they follow it when nothing is at stake. Before entry, the plan gets violated through hesitation and added confirmation. The setup meets all the criteria, but something feels slightly off, so the trader waits for one more signal, one more candle, one more indication from the market. And in waiting, either misses the entry entirely or enters at a worse price than the plan specified, both of which degrade the expectancy the plan was built on. During the trade, the plan gets violated through adjustment. The price moves against the position slightly, and the trader moves the stop. Or the price moves in favor, and the trader takes profit early before the target. Or the trader adds to a position that was sized according to the plan's risk parameters. Each adjustment feeling like intelligence in the moment, and functioning as erosion of the plan's edge over time. At exit, the plan gets violated through hope. The stop level is reached, but the trader doesn't exit because the trade feels like it might come back, turning a planned small loss into a larger unplanned loss that requires more winning trades to recover from than the plan ever accounted for. What genuine plan following actually looks like is simpler and harder than most traders expect. The criteria are met, so the entry happens. The stop is where the plan said it would be and stays there. The target is where the plan said it would be and stays there. And the result, win or loss, is recorded without modification. Because the plan is the vetted version of the trader, and the vetted version made better decisions in a calm state than the live version can make in a charged one. The test of whether you're actually following your plan isn't whether your plan is good. It's whether your live trading results match your back-tested results over a meaningful sample. And when they don't, the cause is almost always deviation, not the market, because the market is behaving the same way it did in the backtest. The trader is not.